Hey folks, Jed Bratt here with your month of July San Diego County real estate market update. In this video, we are going to cover what we always do: sales data, active pending, sold listings. We're going to look at the median price. We're going to take a look at interest rates, see where they're currently at, and the likely trajectory as far as we can see. We're going to look at the 10-year yield. We're going to take a look at the economy, check out the most recent jobs report. We're going to look at unemployment, mortgages and forbearance, rent collections, foreclosure filings, talking about the eviction moratorium that's just ending. Worries of a bubble is something we're going to address towards the end of this. It's something that's coming up a lot. The market is crazy. It's a very, very competitive market for buyers right now. So it's natural that we're going to have some of these questions from buyers, especially as to whether or not we're entering a bubble. So we're going to touch on that. Other considerations I'm going to wrap up with regarding where I think the market's at and where we're likely headed, and what all this means basically for you as either a buyer or a seller in the San Diego real estate market. So let's go ahead and get started, and let's take a look at the numbers, beginning with active listings in June. So in June, we were still down 38.2% year over year on inventory. This is no surprise. COVID has really put a major screeching halt on inventory growth since March. And we still haven't seen this recover. Now, normally we'd be continuing this upward trend in seasonal. We go in seasonal cycles for inventory, for sold listings, for the entire real estate market, really. And usually around July, August, September, we kind of are at the top of that seasonal cycle, and then in kind of December, we're at the bottom, and then January, we always spike up a tiny bit. Well, we've already pretty much capped out for this seasonal cycle, or so it appears, in April and May. And we actually came down in June from where we were just last month, which is kind of incredible, but it's because we're really getting attacked from all sides with COVID, because COVID not only made sellers worried about putting their homes on the market, having strangers come through the property, but it also helped drive interest rates down. And what does that do? When we have these crazy, record-breaking, never-seen-before lows for interest rates, well, that, despite the prices going up, makes homes more affordable for buyers, which increases demand. And now you have these tenants that were sitting inside their apartments, sick and tired of being stuck inside their apartments during shelter in place. And they're more than ever ready to get out there and buy that home they've been trying to get. And now it's more affordable than ever, theoretically at least, due to these crazy low interest rates. The only problem is they don't have a whole lot of inventory to pick from, as we can see here, and it's only getting worse. But, that said, let's move on to the next one. So pending sales are up 20.2% year over year. Solds, we were down only 3.6% year over year. Right now, almost everything that's on the market is selling. The thing is, buyers just have less to pick from. So even though we're drastically reduced on inventory, the number of sales is going to be nearly as high as it possibly can be. And you can see that here, being only 3.6% down. And of course, this is also due in part to a recovery from picking up slack from the first few months of the year during the shutdown. Median sales price is up 2.9% year over year in San Diego. And again, with the major drop in interest rates, this is only increasing buyers' affordability despite prices coming up a little bit. So we're likely going to continue to see this upward trend in price. There's really not much that's going to be slowing that down, with the exception of a few different factors that I'll try to address later in this video. All right, so interest rates, we hit for the first time ever in history. Well, we've been setting like new records consistently every week for the past, several months. But really, if we look at this though, to have the first time ever, the 30-year fixed rate mortgage nationwide to be below 3%, it's pretty nuts. So it was 2.98% for a second, and right now we're sitting at 3.01, but still, nonetheless, that is likely to continue down, and let me tell you why. When interest rates, when everything happened with COVID, the one thing that, of course, investors were flocking to is security. So treasuries are perceived as some of the safest, most conservative investments you can get. If somebody's worried about the economy crashing and losing 30% of their stock portfolio value, well, then what would be a more desirable outcome? Well, even if you're only getting 1% or 0.75% or even 0.5%, like we're nearly at right now in the 10-year treasury yield, that is going to be a more desirable outcome, and you pretty much have a guarantee that it's going to be there. So the 30-year mortgage pretty much follows the 10-year yield, historically speaking, and we are at 0.59% currently on the 10-year treasury yield. Now, interest rates have fallen significantly. We're looking at interest rates, and these are wonderfully low. Let's just do this. Let's look at, for example, April of 2019. We're at about 4.1 something percent on mortgage rates. Now, if we look at April of, let's just look at the beginning of 2019, somewhere in here. So April 2019, we're at 2.56%, okay? So we've pretty much almost on the dot dropped 2% in this period of time on the actual 10-year treasury yield. On our 30-year fixed rate chart, however, we've dropped from just over 4% to about 3%. We're hovering at around 3% right now. There's almost a 1% disparity there. Now, I'm not saying that these are always going to line up perfectly, but the point is mortgage-backed securities and yields are typically competing with the same general type of group of investors, of buyers. And the more demand you have for an asset class, the more it drives the yield down on that. Just like real estate, the more demand you have for something, the prices goes up. Same thing with mortgage-backed securities and in treasuries. Now, with this spread, with this dropping in rates, what's one thing that lenders have received a ton of interest in? Homeowners who already have mortgages have completely swamped the lending industry with refinances. So there, the only limit on refinances is really, are you going to drop your interest rate, and do you currently have a mortgage? And they've been absolutely swamped with mortgage refinances. So whenever this starts to cool down, you're going to begin to see more competition amongst lenders, and those rates even settling down more to the more normalized lows, the typical spread we normally be seeing, because right now what's happening is lenders actually have a much higher profit margin on the loans they're originating and the price they're actually paying for that money. So something to keep in mind, whenever that happens, whenever their pipelines start to empty out from the refinances that have already achieved these incredibly low rates, well, you're probably going to start seeing rates settle down lower. Of course, they're going to get more requests for refinances during that same time as well. But nonetheless, you can just see that the trajectory is likely to continue down for the time being. All right, let's look at the jobs report. So the June jobs report, we gained 4.8 million jobs back on the payroll, which is great, better than expected. We're moving in the right direction, but what's going to happen with the continued shutdowns and the ongoing virus pandemic? We have yet to see, but it is promising, though, to see some positive numbers spring back right away, because that was one thing a lot of people were concerned about, including myself, as to whether or not the employment was actually going to spring back. And don't get me wrong, we're still 11.1% unemployment rate, which is huge. We were at about 10% in 2008. So to have this still lingering above us is nothing to laugh at, but nonetheless, it's good to see movement in the right direction. San Diego's job market also recovered some jobs as well. We went from a 13.5% unemployment rate to 10.2%, so we moved in the right direction, but nonetheless, again, with continued re-shutdowns of businesses and restaurants across San Diego County, among other places, we have yet to see where that's really going to end up in the coming weeks and months. Mortgage forbearance rates took the biggest fall yet, which is good news. So the actual percentage of mortgages that are officially in forbearance, not paying their mortgage, are at the lowest rate they've been since we really had this spike. About 7.8% of all outstanding loans, or 3.9% of mortgages sat in forbearance in the first week of July. This is down from 8.18%. Once again, moving in the right direction. But I still think that we are in the absolute middle of this entire thing, and it's yet to be seen where this is really headed. Missed housing payments continue to pile up in July. 32% of Americans did not make a full on-time housing payment in July, slightly up from 30% in June. The federal eviction moratorium ends today. That is today. So this is July 24th, Friday, that I'm making this, and the federal moratorium on evictions is ending today. What does that mean for San Diego? Well, there are parts of the country that are having significant challenges collecting full rent, it seems. In San Diego, I'm good friends with several property managers. I check in with them and get periodic updates as far as what they're seeing in the San Diego market. And I have to say, we have not seen any prevalent challenges with collecting rents on time. So I don't know that this is going to be an issue. There is a concern among a lot of people that there is going to be an eviction wave. This is going to be an eviction crisis essentially, and that may be the case in some markets. Unfortunately, I don't know the case for other markets outside of San Diego, and I don't even really know exactly what these numbers will look like in San Diego. It still remains to be seen. But nonetheless, that is ending today. Whether or not the powers that be will work on reinstating some new provision or providing some protection for tenants. There is some stimulus going to people who might happen to be tenants, but directly for being a tenant, there is no financial support. And I think that is going to continue weighing heavily on our housing market and the tenants. But in the meantime, you can see people that are flocking to buy homes. Doesn't seem to be hitting our market hard right now. So the question would be, is there going to be a wave of evictions? If so, what's going to happen to these units? Are they going to get filled again relatively quickly? And I think that the answer would be yes. If there is an eviction or if there is a vacancy, homes in San Diego are still flying off the shelves, rentals as well. You know, I don't know that that's going to be an issue directly for San Diego. It might be for other parts of the country, but once again, we will take a look at that and follow that as we go along. Let's take a look at the rent payment tracker. Basically what we were just talking about. The National Multifamily Housing Council reports that 91.3% of apartment households paid rent as of July 20th. So really the number is not incredibly staggering. In the amount of delinquencies, 91.3% are making their payments on time. And this is the National Multifamily Housing Council stating this. So, all right, so taking a look at foreclosures, the foreclosure data as of the first half of the year in the United States, 165,530 properties with foreclosure filings in the first 6 months of 2020. This is an all-time low for foreclosure filings. And once again, we already know that actual foreclosure filings are largely being pushed by the wayside. So will there be a wave of foreclosures at some point in the future? Possibly. There also seems to be a great deal of patience and generosity regarding stimulus and trying to protect people that are having trouble making their payments. As we can see from forbearances, there may be many people who, COVID aside, would have had trouble paying their mortgage anyway, unfortunately, and they might actually be benefiting due to this entire situation and the leniency laws, such as forbearance options, that they might not have otherwise been experiencing. So whenever this all catches up, whether it's in 6 months, 12 months, or 24 months from now, I think we're going to see a bump in foreclosures without a doubt, but it's going to be down the road. It might take many, many, many months, possibly several years, before we actually catch up due to the new kind of mode of patience and the programs available to borrowers that are having trouble making their payments. Estimate of median housing. Now, I wanted to touch on this because there's a lot of people that are concerned that we are getting way ahead of ourselves in the San Diego market and that we might be entering bubble territory. And while it's definitely a plausible concern, especially when you consider how quickly homes are flying off the market, the bidding wars we're in, escalation clauses left and right, many times 10, 15, 20 offers. That's almost the norm right now in San Diego. Again, for something that's priced well, there's nothing majorly wrong with the property. It's going to fly off the shelf. Now, the thing is, the reason I brought this graph up is because this is the housing affordability index, these over here, just two different scales. They're essentially measuring the same thing. Then the San Diego Home Price Index and the Housing Affordability Index, just for reference. So we can see that no doubt, if we look at the home price index in comparison to the median income of a household, you could see like this is completely out of whack back in the last housing crisis. That was an absolute bubble. If you were to look at the numbers on a chart, you could look at that and say, this is completely out of sync, out of whack. Incomes are not going to be able to put up and keep up with this major increase in housing prices, and it absolutely had to fall. Now, if we look at today, and we look at San Diego housing prices and the median household income, we're really climbing nearly parallel. In fact, if anything, there's been more of a little spread in the recent bit here on incomes growing almost faster than housing prices, which is very reassuring as far as saying, okay, this is not going to be something that's unsustainable to maintain. Household incomes are continuing to rise along with the prices. Now, when we put that together with low interest rates, this affordability only becomes even more magnified. So this is just looking at the mortgage debt service payments as a percentage of disposable income, and then the U.S. National Home Price Index just for reference. Because, folks, this isn't just happening in San Diego. It's across the country that there are a lot of bidding wars, that you can't build a property fast enough. Offers are being submitted at full price. Properties are going pending before they can even get the inside finished out on tract homes in different communities. So there is a tremendous shortage of housing across the nation right now. But if we look at this and we see the mortgage debt service payments as a percentage of disposable income, which is the blue, look at this. We see the home price index is going up while the mortgage debt payment as a percentage of personal income is like at all-time lows. So, I mean, if you look at this, it's the absolute opposite. Once again, we can spot a bubble in the leading up to the 2008 financial crisis. The fact of the matter is right now, it's supply and demand. There's way more demand than there is supply. Interest rates are super low. This is a huge benefit to any buyer, even if they have to compete over things, because you're paying tremendously much less, not only in your monthly mortgage payment, but you're also paying down your balance much faster. You're building equity at a much higher rate. That's why buyers are okay with prices going up and still maybe even paying more than they would have 6 months ago, just so that they can get their foot in the door of home ownership. Now, how does this benefit you as a seller? Well, folks, this is the hottest market for sellers I think we've ever seen in San Diego, probably in the nation. With these kinds of interest rates, you are having buyers beating down your door trying to buy a property if it's priced well. Anyway, folks, I hope you found this video helpful. If you found any value in it, if you could hit that like button, I'd really appreciate it. If you haven't already subscribed, as always, thank you for watching, and I will see you in the next video.